Welcome back to 15 Minutes of Finance. This is the tax plan where I help you keep more of your money. Today's topic is marginal tax rates, and we're going to dispel some of the myths around, quote, moving up a tax bracket and other myths around the tax system here in the United States. What I want to make really clear in this episode is I want to give our listeners a better understanding of how the tax system works, what you're taxed on, and how to utilize this knowledge to tax plan better. So let's start with a misconception that I hear very often when I talk to clients. And that goes something like this. I get an email or a call from a client and they say, I'm taking another job. I have a 10% raise, or I did really well at my job this year. My boss is about to give me a $10,000 bonus. Should I be worried that this is going to move me up a tax bracket? That is fundamentally incorrect about how taxes work in the United States. Okay, so let's dive into why that's wrong. So what are tax brackets? Tax brackets are the brackets in the United States that set what income is taxed at what rates. So to use an example, and I'm just going to be using some examples as I do calculations for you of individual tax rates. If you're married filing joint, just double all of these numbers. So if you're single, the first $11,600 is a 10% income bracket. Okay, so if I make $8,000, I'm going to pay $800 in taxes, right? Simple. I'm in the 10% tax bracket, so I'm going to pay 10%. If you're married, remember you're just doubling, so that's $23,200. The first income up to that amount is going to be taxed at that rate. The next bracket is from $11,601 to $47,150. So now let's say I have $25,000 in income. I'm going to pay 12%. Wrong. That's where the misconception comes in. So let's talk about how that would actually be taxed. Marginal tax brackets, and that's how our system is set up. We have a marginal tax bracket system. So what that means is you do not pay the new tax bracket percentage on all of your income. You pay that new rate on the marginal amount of income that has exceeded the previous threshold. So let's break down a calculation to crystallize this. It'll make sense once we go through this. In this scenario, I made $65,000 in income. And we're simplifying everything here specifically so that we can talk about the way that tax brackets work. It's never this simple, right? There's the standard deduction versus the itemized deduction. I might have other what are called above the line or below the line deductions, which is a term describing, does that deduction come before and factor into AGI, or does it come after AGI, which it refers to adjusted gross income, to arrive at my taxable income. So there's above the line and below the line deduction. So when I say $65,000, I'm talking about that's my taxable income. There's more complexity to that. If I make $65,000, I'm not taxed on $65,000. There's going to be some form, whether I take the standard or the itemized. Maybe I have student loans. Maybe I contributed to a traditional IRA. There's still considerations, but I just want to make it clear that we're being very simplistic here for the purpose of demonstration. So I have $65,000 in taxable income. I do not pay. So the third tax bracket we should probably talk about. So from $47,151 to $100,525 is now a 22% bracket. So I don't pay 22% in taxes just because I'm in between $47,000 and $100,500. Here's how my tax system works. My first $11,600 I pay 10% on, which is $1,160. Easy calculation. Tens are always easy. Just move over the decimal place. The next amount of income, so everything I made that was over 11,600 but under 47,151, so that's $35,500. That next amount, so that's everything in between the end of my last bracket, 11,601, all the way to the end of this new bracket, 47,150. That's taxed at 12%. So on that chunk of my income, I'm paying $4,266. But I made $65,000. So part of my income is in that next bracket between $47,151 and $100,525. That amount, so I made $65,000. So the amount above the $47,150 is an extra $17,850. That's taxed at 22%. So on that third level of my income, let's call it, I pay $3,927. Okay, so this is the way that the marginal tax bracket system in the United States works. You don't move up a bracket. You pay marginally more per bracket based on how much income you have. So there's two important things to take away from this when you're tax planning, you're creating a tax strategy, and if you're working with someone who's trying to do tax projections or is trying to answer a question for you, such as, how much should I withhold from this transaction for taxes? Okay, so that's a common question. I'm going to make this bonus. How much should I withhold? I'm expecting to earn some extra money door dashing. It's an extra $10,000. How much tax should I withhold on that? There's two numbers that you're going to want to consider and that someone will need to help you answer that question. The first is, what is your marginal tax bracket rate? So I'm not paying, when I make $65,000, 22% on all my money, right? We just broke it down. We're going to pay $10,000 on the first chunk, then 10% on the first chunk, then we're going to pay 12% on the next chunk, then we're going to pay 22% on the next chunk. And if my income was $400,000, then I would pay now 24% on what exceeds $100,500, but is not more than, I think the next bracket is 193, 91, something like that. And then above 191, I would pay 28%, right? It would keep going up incrementally and marginally. So we need to know, though, what my marginal tax bracket is, because when I make $65,000, I'm not paying 22% on all my income, but any new income I do make is going to be subject to 22%, right? Because that's my marginal tax rate, meaning that's the current bracket that I'm in, right? I maxed out the 11,610 or 11,6 bracket. I made more than the maximum of the 12% bracket, 47,150. I'm in the third bracket. I'm in between 47,000 and 100,000. So I need to know that number. That number is your answer to what am I going to pay on any additional income. If I make $5,000 extra dollars next year, well, I'm going to pay 22% of that new $5,000. So any additional dollar of income is going to be taxed at 22% up to $100,500, and then now every new additional dollar would be subject to 24%. So marginal tax rate is a very important component of total taxes paid, okay? Because it tells us if I make more money, how much am I going to have to pay in taxes on each additional dollar? The second thing we want to know is, what is our effective tax rate? So the effective tax rate is how much did we pay in taxes. And that's a really easy calculation. If you're trying to project into a future year, very easy to calculate if you have last year's tax return. So our effective tax rate is what percentage we actually paid on our income, okay? In this case, our effective rate is about 14.4%. And we get that by adding up all the taxes we paid. We paid 10% on the first 11,600, that's 1160. We paid 12% on the next 35,550, that's 4266. Then we paid 22% on everything above that, but below 100. That's a total of 3927. We add those all together. The tax that we owe is $9,353. And you usually don't have to do this calculation. Just look at your last year's tax return. One of the very bottom lines on your 1040 is total tax due. Okay, so just look at your total taxes and divide by your total income. And that tells you your effective tax rate. So those are the two important rates to know. If I make more money, what's my marginal tax rate that every new dollar will be taxed at? And what am I actually paying in taxes total? What is my effective tax rate? Okay. So that's how the tax system works. That's how marginal taxes work. And they're not all like that. So this is how individual tax brackets work. To contrast this, a couple years ago, we changed the legislation around corporate taxation. We now have a flat rate. So corporate income, so C corporation, a big company, their income is taxed at a flat federal rate of 21%. So it doesn't matter if the corporation made $25,000 of income or $25 million of income. We take income, we multiply by 0.21. That's how much your corporation owes in taxes. Okay, so C corporations, they pay their own taxes. That's an example of a flat tax system. Okay. Now there's also capital gains taxes. They work similar to income taxes in that they're marginal, but they just work in significantly larger chunks, you can say. So the first 47,000 of capital gains, the rate at which capital gains are taxed if your income is under $47,000, okay, is 0%. From 47,000 to it's somewhere in the 200,000s is 15%. And then long-term capital gains above that are 20%, and that's where it caps out. So capital gains is kind of a mix between the two. There's one of three rates depending on how much income we earned, and we're going to pay on our capital gains one of those three rates. So there's lots of different ways that taxation works, but in terms of I'm going to jump up a tax bracket, that's a misconception. And now that we understand what are marginal tax rates and how to use them, we understand the answer to these questions. The answer to, is it worth it to make more money, is always yes, tax-wise. There are certain threshold black and white things where there are scenarios, and we won't dive into this. I'm not going to get super political here, but one of the arguments against the current welfare system of the United States is that there are so many cut and dry benefits provided to people, assuming they're under the black and white line of poverty line or not. There's food stamps, there's healthcare subsidies, there's all sorts of aid, there's rent, Section 8 housing, lowered rent incentives. So there's all sorts of incentives. In terms of the total picture, the totality of your situation, there are people who, if they make a couple $1,000s more, that jump does actually, it's worse for them. That's a big issue with getting out of poverty, is you have to make a leap out of poverty, because if you make a step out of poverty, you lose so much that you're functionally making less. That's not how taxes work, okay? So there are situations other than tax in your life where you can make more money, and therefore you exceed a threshold that cuts out so many other economic incentives or welfare subsidies to you that you can be worse off by making more money. That's a real thing. Tax-wise, making more money never nets you less money. Because if I'm making $47,000 flat, right? We know now that $47,150 is the $150, is the marginal rate to pay 12%, right? So if I make another $1,000, I'm now in a new marginal tax bracket, right? I'm now in the 22%. But because they're marginal tax brackets, I'm only paying 22% on $850. It's the amount of my income that exceeds the high end of the 12% bracket, which is $47,150. So if I'm making 47, I get a $1,000 raise and I'm now making 48. I didn't jump a tax bracket in the sense of how a lot of people think about it. I am in a now larger marginal tax bracket, okay? But I'm not overall making less money. I'm paying more on this next 850. So instead of getting, 88% of it because I'm paying 12%, I'm getting 78% of it because I'm paying 22%. But I'm still making more money than I was making $47,000. So you'll never make more money and then pay more in income taxes because that's not the way marginal tax systems work. So I hope that has made that clear. I know I've kind of belabored this point, but it's very important to understand. So what is the consideration of marginal tax bracket? So there are some. Using this knowledge, there are important considerations to make. One of them is timing, okay? So let's say you know that you're going to get a bonus and it's going to happen at the end of the year. But let's say you're going to retire next year halfway through the year, okay? So you're making $40,000 or let's say $45,000, okay? You're making $45,000 and your boss is going to give you a $10,000 bonus. You've been there for 20 years, okay? Remember that everything above $47,150, so that's more than $8,000 of this bonus is going to be taxed at 22%. If you were to get the bonus on January 1st, well, next year you retire halfway through the year. So you only make $22,500. That whole bonus, okay, still puts your total income to just $32,500, right? That $10,000 bonus. So now you're paying 12% still on the entire bonus, right? Because you're in a lower marginal tax bracket. Again, in either of these scenarios, getting that bonus doesn't net you less money, right? You're always getting money. There's no tax that's over 100%. So because we work up marginally through our tax brackets, we're never making less money by getting a bonus. But we've seen that we're able to pay less taxes on our bonus by having that income come through in a year where our income is lower. So people, especially business owners, they tax plan around this all the time, right? If I'm having a really great year, and if I'm an LLC or an S Corp or a partnership, sole proprietorship, whatever, all of those are called pass-through entities. So the income gets reported on my own tax return, and I'm paying personal marginal income tax bracket rates on them, okay? Different than C Corp. I won't get into the specifics of small business taxation and what flow-through means, but all you need to know is the income is taxed at the person's tax rate, okay? So it's a pass-through to me. So if I'm running a business and I'm having a great year and I need a new business vehicle, I need a new truck for all my supplies, I should be buying that truck in December because I want that write-off in December, okay? I'm going to buy a bunch of supplies. Maybe I go out and I buy a bunch of paper and printer ink, right? And I spend $1,000 for the whole year ahead because I know that this was a really great year. It's not going to be this good last year. I got a bunch of new contracts. Maybe they all pay up front. I know I'm not going to make this much next year. I want more expenses this year because I'm in a higher marginal tax bracket. So I'm going to pay more on my income this year. I want to write more of that off. And the same is true of claiming revenue. I'm already having a really good year. I am talking to 5 different people who are going to sign contracts. It's December 22nd. Hey guys, hope you have a great Christmas. Let's get those contracts signed January 1st, right? If you haven't done any work for them, there's no, you're not like avoiding some taxation and being fraudulent because like you've performed work and you're just refusing to cash checks until next year, right? We're not doing anything shady. We're close to next year. And so we're going to sign that contract and we're going to get paid next year. We're not going to do it this year. There's only a week left, 2 weeks left. I know these are extreme examples, but you can use these to understand how there is definitely some planning element to the timing of recognizing income and expenses, or functionally earning income or accruing expenses. And you can postpone work, or you can postpone payments, things like that, to plan around the year that you think will have the lower marginal tax bracket. Okay. In retirement, this becomes super important. This is all you're doing in retirement is you want to pay as little as possible, because all of your retirement income is livable income, right? Like you're in retirement, you're not earning income through a job anymore. So it's very important to keep more of your money. Maybe take a little bit less of that IRA withdrawal or 401k withdrawal in the current year. Next year you're going to get a gift from somebody, or your home's almost paid off. So halfway through next year, you're not going to have as much of a mortgage. And so you don't need quite as much income next year. Just accept a little bit less this year so you can pay just 12% on everything you took out, or just 22%, and then take more next year. And instead of doing 110 and 80, just do, what's the math on that? 190. So take 95 and 95. And now none of our income was taxed at 24%, right? So we can plan timing wise around marginal tax brackets to try to create income and expenses that most reduce our taxes by having expenses in years with the most income to reduce our marginal tax rate, and earn less income in years where we've already earned a lot of income, so we're not having a portion of that income taxed at another higher marginal tax rate, right? So you can pay less taxes by having a good understanding of tax planning, by understanding your marginal tax rate. How much income will it take to get to the next marginal tax rate? How much expenses would be required to drop me to a lower marginal tax rate? But you never make less money by making more money and getting, quote, bumped up to a higher tax bracket. That concept is a myth, even though the overall concept of planning around marginal tax rates is super important and has actual impact on the amount of money that you keep in your pocket. That's everything that I have for today, guys. I hope it was informative. A lot of people probably understand this. I hope the last bit about planning around this was a little bit insightful for you. If this feels like review for you, most people don't have a really good understanding of how taxes work. Maybe they do it themselves. Maybe they go to H&R Block. Someone does it and they pay taxes. They don't understand the system. This was one of the most things I came out of college as a accountant with a degree in accountancy, is like an understanding of, I had to take two semesters of performing arts, theater, and I don't even remember what the other one I took. There's no class that teaches you about taxes. Okay. So don't feel bad if you're like, wow, I've totally been guilty of this. I've postponed bonuses or not postponed, that can be advantageous. I've not taken a pay raise, or I've had to ask, should I take a pay raise because I was worried about moving up a tax bracket as some kind of boogeyman that would cost me money. There's no shame in that. Very few people are taught how taxes work. So that's how they work. They're marginal. You never go up a bracket overall. You just continually pay a higher rate on every dollar of income as you make more and more money. That's what we mean by marginal tax brackets. So understanding them when we should create income, when we should write off expenses, when we should report capital gains. That's a big consideration. If I'm making less money this year, I shouldn't wait to sell that stock in January when I'm going to make more money next year. Now I'm going to pay the 15% long-term capital gains tax rate, where if I was under the 47 in this year, or for married people, 94,000, that's a good amount of income. There's a lot of people that can pay nothing on their long-term capital gains taxes, right? But if you sell all your stock in a year where your income is already super high, you're paying a high marginal tax on your regular income, and you've made your long-term capital gains subject to 15%, where if you waited until next year, you keep your marginal tax rate lower, and if you can stay under 94 next year, when maybe income is a little lower, you didn't get that bonus next year, you moved jobs, whatever it is, you might be able to pay nothing on your long-term capital gains and save 15% of that gain. So this can be super significant. It's a very important part of tax planning, and I hope you've learned some tools of how to do this analysis for yourself and make good timing decisions around your marginal tax bracket and your effective tax rate, and how to utilize those concepts for your own benefit. As always, please submit any questions, any future topics, things you would like answered and covered in future episodes. We'll continue making content that hopefully helps you save more money. And as always, invest early, invest often. Thanks.